3 p.m. live from our studio in New York City. I'm Julie Hyman. Today, that's Madison Mills next to me, and this is Yahoo Finance Live. Here's what we're watching this afternoon. The market looking like it will not be closing at new records to close out 2023. The major averages pulling back across the board with 1 hour left in the final trading day for the year. We'll be looking back at the biggest winners and losers, and there are some that might surprise you.
And one thing that we do know, big tech, obviously a big year. The Nasdaq on track for its best year since 2003. We've got a closer look at some of the key names that you're going to want to watch heading into 2024.
And in today's edition of Goodbye or Goodbye, the battle between growth and value. One top strategist explains why you might want to consider value heading into next year. Let's get you up to speed on the market action. A little bit of a step back, a little bit of a pause, a little bit of a breather in the increase that we have seen in stocks. The S&P 500 still poised to end the year on its winning streak on a weekly basis. 9 straight up weeks for the index, its longest rally of on a weekly basis in almost 20 years. But today we are seeing a little bit of a pullback from those record levels here. We had been looking at that record closing high of 47.96.56, but it had been inching up there, but it didn't quite make it there today. Doesn't look like it's going to, Maddie.
Well, I had a great source call earlier today with someone who happens to be on our set right now.
We'll talk to him in a minute.
We'll get to in a minute here and get more talking points out of my mouth on that. But he pointed out to me that it could be a little bit of some options expiring, some of that on the last day of the quarter, but that's not necessarily what we should be putting all of our ducks into when we consider what's happening in the trade today. And also that we did have all week and we never got to that record-breaking high, which is very sad for me. I was really hoping to break that news right here with you, Julie.
I know, I was too, but at least we get to be together on the last trading day of the year. Not surprising, we're seeing volume way below where it tends to be. Not a lot of people around this week, so factor that into the story of the trading session today. When you look at the story of the year, however, it's a pretty good story when all is said and done for equities, but not just for equities. Almost across the board for a lot of different asset classes. The Dow, the S&P, and the Nasdaq all higher on the year. The Dow did just close at a record. The Nasdaq 100 did just close at a record, even if they're not going to repeat that feat today. The Nasdaq 100 looks like it's closing in on its best year. We'll have to look at the numbers as we get down to the wire. Could be the best year since '99 for the composite, since 2003. So we'll see where that all shakes out. But obviously that reflects the absolute dominance of tech and the Magnificent Seven that we have seen this year. And of course, tech was the best performing group along with communication services.
And I'm so curious to see whether or not we continue to get evidence that there is broadening out beyond those seven names. Having said that, we did not see all rising tides lifting all ships this year. The S&P 500 consumer staples, utilities, and healthcare sectors lagging consumer discretionary and comm services by the largest margin on record, Julie. So it's interesting when you talk about the tech sector really holding up these other 493 names. We're seeing that apply across a sector basis as well. Do we talk about the bond market? Are we going to talk about?
We should talk. I think we should talk about the bond market.
I mean,
it was a crazy year for the bond market, and yet we're ending where we started, more or less, right? Which doesn't encapsulate or capture the absolutely wild ride that we had. I mean, in a very short period of time, the surge in yields and then the really collapse in yields that we have seen over the past couple of months. That, by the way, has then circled back into the equity market because we've seen a recovery in some of those interest rate sensitive sectors like utilities and real estate. Not enough to salvage the year for those groups, but enough to give them a little lift here. But we're finishing the year with the 10-year yield pretty much where we started.
And then you had that 7-year auction last night that was pretty mess. So I wonder what that means about the appetite for some of these longer term treasuries heading into the new year. But also I have to compare the 10-year yield story to an abusive boyfriend. Like just so much choppiness. You never know what you're going to get. It just doesn't feel like, if you look at the trade today, exactly like you said, it's not telling the full story of the volatility from the year.
And obviously the big question going into next year for bonds and for stocks is going to be, when is the Fed Fed going to be cutting rates? How many times is it going to be cutting rates? And that's really already been the biggest topic of debate as we head into next year. Just rounding it out, a couple other things we're watching. Energy stocks were down on the year, and that's as we saw oil prices, the biggest drop on an annual basis since 2020. That reflecting kind of just the supply demand dynamics out there. Even as OPEC Plus stuck to its production cuts, we didn't see that $100 oil.
I know, and I'm so curious too. I heard someone yesterday saying that they would not say no to an $80 a barrel oil trade heading into next year. So do we see prices get that low? And how great would that be, by the way, for those folks running for president this coming year? Some not great news, though. The dollar on track for its worst year since 2020, of course, as the market is pricing in those Fed rate cuts. Does that continue to lead to dollar weakness heading into 24?
And then one more thing I got to mention. Bitcoin, the dark horse of the year, it feels like, right? It kind of crept up on us, the huge rebound that we saw in Bitcoin in anticipation, which we've been talking about a lot in recent days, that there is going to be an approval from the SEC for at least one, probably more than one, of the Bitcoin spot Bitcoin ETFs. At least that's the anticipation. That seems to be the broad expectation at this point. We'll probably get some news one way or the other in early January.
I hope we get a little bit more clarity in some of the commentary, at least. If not in the dot plot, at least some fun quotes from Jay would be great for me.
Some fun quotes from Jay, some fun quotes from the SEC on Bitcoin. Yeah. Well, I'm sure we're going to have a very busy year again.
Yeah.
All right. Well, let's talk more about all of this as we continue to look ahead to 2024 and what investors should be keeping their eyes on in the new year. Joining us now on set, Steve Sosnick, Interactive Brokers Chief Strategist, and also joining us remotely, Keith Buchanan, Global Investments Senior Portfolio Manager. Keith, I want to start with you, actually. We've been talking about the year that was. And so as we kind of look ahead to 2024, what do you think is sort of the biggest surprise or wild card as we go into next year?
Well, thank you so much for having me. It's good to be back. As we look to 2024, we've focused on a couple of things, actually. The gap between the Fed expectations that they put out in the last, you mentioned dot plots a second ago, the Summer of Economic Projections earlier this month, and where the market is pricing in the Fed will take rates in 2024. There's an 85 basis point gap. And typically when that gap gets that wide, we've seen Chairman Powell push back. You talked about those fun quotes, a lot of those. The most fun we had was him really pushing back, there will be pain, and the Jackson Hole speech, where that gap was wide and he pushed back, trying to reel the market back into where he thought things were projected to go. Now as that gap is back wide again, we've seen a couple of weeks ago, not really a pushback that was received by the market as kind of, moving forward with what the market was expecting. We really feel like there has to be some reconciliation between those two. The Fed expectations and the market's expectations, and risk assets are priced off of both of those, as we both know. So the equity rally that we've enjoyed has been because rates have moved lower. Naturally, the bond market has moved higher because rates have moved lower. And we're really concentrating on that gap and what it means for risk markets going forward in 2024.
Well, I see our guest on set nodding his head, so I want to go to you on this, Steve. What is your take on what the sort of everything rally has meant over the past month and what that means heading into 2024?
Well, thanks for having me, Madison and Julie. Great to be here. But what I was nodding because I wish I could push back and give you some debate with Keith, but he and I seem to have a similar opinion. Basically, the fixed income markets have been ahead of the Fed for quite some time. They'd been predicting rate cuts in 2024, even when the Fed wasn't. And then basically the Fed came out recently and confirmed it in the last dot plot, saying, okay, we acknowledge that you're looking for 3 to 4 rate cuts, and we're looking at 3. We generally agree. So immediately the market said, okay, we're looking for 6 to 7. As Keith was alluding to, it's implausible that you get an economy simultaneously strong enough to give you good earnings growth while still being bad enough to require 6 to 7 rate cuts. Mm-hmm. You got to be careful what we wish for here. And so, if the economy is solid enough that we get the soft landing that equity markets are looking for, well then bond rates have to back up, sort of maybe not back to 5, but probably into the mid to low to mid 4s, let's say. Well, that becomes a headwind for stocks. If we get the 6 or 7 rate cuts, Well, that's not good for anybody because that means the economy is probably in a bit of free fall. So we really have to resolve. In the meantime, right now, end of year is in play. The everything rally's in play, and right now, for the last 2 months, you pretty much could have just closed your eyes, bought anything, and it would have worked for you.
So, which you got people like you never like to hear, because then what are you for if you can just close your eyes and buy everything? What are you for? But you know what I'm saying? Like, you want to be able to gain an edge here. So, Keith, going into next year, how do people gain an edge? What is going to outperform here in this sort of, gap environment, as you talked about?
Well, I'm glad you asked that, Julie, because that's why we earn a fee. We feel like financial, particularly in the banks, the banking sector, there's some opportunities that have arisen because of the rate environment that has really taken hold the last 2.5 months. If 2022 was in a nutshell, we'd say that was the year that the market was trying to catch up with the Fed moving higher. 2023 was the market catching up with just how much higher for how much longer. 2024 seemed like higher for longer turned to higher for not much longer. And we're looking for the different parts of the market that really haven't started to price that out in the most specific ways. And financials, even though they have run, the low-hanging fruit seems to have been harvested. But looking forward, price tangible book at this point in the economic cycle really isn't to where it has been historically. There's still a discount that's been priced in. Now, some of that's commercial real estate, which is largely held by some the regional banks, and it has a little more exposure there. But as we look past last spring, the deposit lessons learned, liquidity lessons learned, as well as some names picked up really good assets at really cheap prices, given the turmoil from last spring. So we're looking selectively, but warming up to what the financials and particularly the banks can offer, especially when you look up at the market cap scale to some of the bulge bracket banks.
Keith, I love the way you kind of described all of those different soft landing scenarios, because as you say in your note, the whipsawing of this market is not necessarily a good thing. So, Steve, I want to go to you on this, because earlier I asked you this question. Who is smarter right now, the bond market or the stock market? And what does that tell us about the landing?
This is the tricky part. For years, I've always said when the stock market and the bond market disagree about the economy, trust the bond market. Problem is the bond market got it much worse than the stock market this year. The stock market really did get it right in looking for a decent economy, and that's what we got. The GDP numbers have been solid all along. We've been, consumers are continuing to spend. Companies, for the most part, are making good money. Whereas the bond market has had this massive inversion. It's not as massive now as it was before, but it's still. 2-year yields are still 40 basis points, give or take, above 10-year yields, which is, by historical standards, a quite dire prediction. And as Keith and I both mentioned, 6 to 7 rate cuts priced in as a pretty dire prediction. So, first of all, I'm hoping the stock market got it right, because I really don't. None of us are rooting for catastrophe, and so. I don't know, because I think the bond market, which had been the more reliable economic barometer for so many years, decades, it kind of didn't work last year. And so it's your guess is as good as mine, I guess, at this point, right? They couldn't give bonds away at 5%, and now you can't get enough of them at 385, 390. Who's rational there?
I mean, so Keith, that sort of calls into relief the big lessons, as you said, lessons learned of this year, when so many folks had so much trouble predicting what ended up happening. So as we look into next year and try to figure out what's going to happen, how do you sort of key off what we have seen? And how do you avoid the sort of historical bias now of just assuming that maybe the economy is going to be stronger because it was stronger this year when nobody thought it was going to be?
So I hate to keep agreeing with Steve, but we keep going back and forth on different points that have been made. I'll just juxtapose one that was mentioned. As we look back to 2023 and 2022 especially, as rates started to move higher, we had this within the marketplace, this angst that inflation was out of control. The Fed was going to have to put the economy into recession in order to control it. Let's not, don't own any risk assets. That was 2022 in a nutshell. As we move forward to now, we had the bond vigilantes came out and really flexed their muscles a couple of months ago. And the big question was, how contain is inflation? What does the Fed have to do to contain it? Our fiscal situation is from a debt to GDP standpoint, is getting to a level that causes concern, as well as, from a fiscal standpoint, we just can't agree to anything on Capitol Hill to get any solutions that could possibly rein in our fiscal, deficits and then the debt as a result. Those last couple of issues still aren't resolved. And we had inflation seemed like it's headed in a trajectory that's sustainable and positive, but really we're still, the last mile is still right in front of us, getting back to 2%. So it was, I think the positioning of the market dictated a lot of the violence of the move. There's never been shorts on treasuries the way there were a couple of months ago that shifted back in a very violent way. I think you saw a relatively similar effect in equities. So the last couple of months or so, we want to make sure we keep that in the context of what's going on and the cause and effect and what's really materially changed in order to cause the type of shift we've seen in risk asset prices.
Right, and it's never good when the Fed and the market seem to disagree moving forward. So we're going to have to bring smart folks like you on again to continue the conversation. Keith, thank you so much. That was Keith Buchanan, Global Investment Senior Portfolio Manager, and of course our own Steve Sosnick, who we're going to have back on set for Goodbye or Goodbye in a little bit. Thank you both so much. Moving on to some trending tickers here. We have Fisker shares surging after the EV maker says in January the company intends to announce a plan to further accelerate sales and deliveries. While EV startup Faraday seen shares drop after getting a notice from the Nasdaq exchange over its failure to comply with listing rules. And Julie, this is not only a discussion here about the Nasdaq listing rules, but also I think an important discussion about the EV space in general and what that's going to look like next year.
Yeah, absolutely. And what it has looked like, right? Where you have had Tesla still dominating when it comes to EVs. The major automakers not really seeing things pan out as they had wanted. And then you have this whole cohort of sort of fringe players, if you will, the ones that either have higher priced vehicles or more experimental vehicles that aren't quite getting there. And these two companies kind of fall into that category. So Fisker also talked about its delivery surging from the third quarter to the fourth quarter by 300%. For the full year, though, it only made just over 10,000 cars.
Right, wow.
So it's just not, granted, it is a high-priced offering, it's a specialty offering, but it's just, in terms of volume, it's just nowhere near some of the other players.
Right, and to your point, I think 10,000 vehicles for the year, about 4,700 delivered. Those are pretty small numbers compared to those big names. It's hard to compete with a behemoth company here.
Yes, well, we'll see what happens, obviously, going into 2024. And we are also watching shares of ride-sharing companies, Uber and Lyft, following downgrades by Nomura. Lyft downgraded from neutral to reduce. Uber hit with a downgrade to neutral from a buy rating. There was also some insider selling that was going on when it comes to Lyft from the chief accounting officer. So sometimes that just puts some additional pressure on things here. So also what we're watching here is Nomura saying there's limited room for Lyft to increase its take rates.
Yeah, and I think that's such a great point because the driver spending growth, they say, is outpacing driver earnings growth. And it's hard for these rideshare companies to continue to have pricing power on their rides when gas prices are up, when they're having to pay for drivers and continue to increase wages. And then for a company like Lyft, their bike sharing business is also continuing to drag on margins. So I think that's another challenge for them.
Yeah, well, we'll be watching both of those this year. Although both of them, I think, were up on the year, but Uber was up a lot more than Lyft.
Yeah, exactly. I mean, we all know, all of our friends that probably use an Uber, not a little bit more than Lyft. And so that, it just depends. I don't know. Yeah. I like to look at the anecdotal indicators, even though we know not to always believe
Trust
in them
those,
here.
yeah.
Exactly. Moving on to another trending ticker, BGC shares popping after the company updated its outlook for the fourth quarter of 2023. BGC expecting to hit the high end of its revenue and adjusted earnings guidance as well. And again, just updating that outlook for the fourth quarter and giving a little bit of excitement to the street when it comes to that, Julie. But I don't know. I mean, I have to wonder whether or not this is one of those names that's going to be impacted by the overall macro environment next year, or if this is just a case where good news can actually be good news.
Yeah, BGC, brokerage, financial technology company, Howard Lutnick, the chairman and CEO, saying that the business performed strongly through the fourth quarter. That seems to be what the market is keying in on. In addition to that, Lutnick has been trying to launch a competing treasury platform to the CME, which has just dominated in treasury trading. And he said also in the statement, we've made significant progress with FMX, which is this platform, on multiple fronts during the quarter. We expect to have CFTC regulatory approval and announce our strategic partners in early 2024. So it seems like that's something that the market is watching for as well, not just investors in BGC, but sort of people who trade this stuff as well.
Sure.
So that's sort of an interesting, perhaps side note to this story as well that we'll continue to watch.
That's a great point. The regulatory approval can, as you know, often really move a name.
Yeah,
so once
right.
that comes, we could get a little bit more clarity about the long-term story for this name.
Yeah, so we'll keep watching and keep on top of it.
Yep.
And we're just getting started here on Yahoo Finance Live. Coming up, the final closing bell of the year. Will we see any record-breaking finishes from the major indices? Right now, it's not looking great, but we'll have a lot of records probably in individual stocks. We'll have more coming up.
Well, we're obviously focused on the markets on the last day of trading for 2023, but we're going to dive into the sector that's been driving up those markets. We're going to focus on big tech. This is the year the big tech got disciplined following big layoffs that started in late 2022 and continued into this year. Of course, one area where we did see spending from the big tech names was generative AI. The wave of enthusiasm seemingly overwhelming anything else going on in the sector and driving big gains that lifted up the entire S&P. So to talk more about some of those specific names, we've got Rohit Kulkarni, Roth MKM Managing Director. And Rohit, thank you for joining us. I want to start on one of the specific names that I know you cover, which is Meta. Zuckerberg's year of efficiency really leading to efficiency in this name, having their best year ever by a mile. So I'm curious, what are you going to be looking for heading into 2024 to indicate continued growth for Meta?
Hey, thanks for having me. We still like Meta. We think Meta goes to new all-time highs. There, I said it. Sometime during 24, Meta is going to go to new all-time highs that we saw even prior to COVID. How do they get there? I think they have clearly indicated to the street that they are going to be efficient. They are going to grow more efficiently, so we expect margin improvement. They have already set a clear milestone when they gave out guidance for expense growth for next year. On top of that, there are revenue growth drivers that we are getting increasingly warmer to. You think about what they're doing with messaging apps. I think that becomes a $10 to $15 billion business in mid of next year. Then you think about what they're doing with vertical videos, reels. That becomes another $10 to $15 billion business by middle of next year. So when you start adding those up, and then there's Threads. Threads was the most downloaded app during the month of December by some measures. And so they start monetizing Threads at some point in second half of next year. There's elections, so there is going to be more drama there. So I feel there are new revenue growth drivers. There is measured expense growth. And then obviously the last point is this experiment around virtual reality, augmented reality. What happens to the ecosystem? What does Apple do? Whether they bring a new product that is so far out of reach that people go to Meta just for experimenting it even more. So there are these three things that we are going to track next year, and that's why I feel Meta goes to new all-time highs.
Rohit, a bold call there. I like your there, I said it. It's going to new all-time highs. It's Julie here, by the way. I also am interested in your take on this sort of image of Meta at this point. It feels like it sort of got an image makeover this year. Yes, there was still been a lot of reporting out there on the practices on Instagram, for example, lack of mediation, if you will, in certain areas. But in others, it seems like the heat has kind of come off. Is it just that so much heat has been on the likes of X and Elon Musk that now Mark Zuckerberg looks better by comparison? Or has Meta been doing some things right this year to push its image in that direction?
I think it's the prior than the latter. They obviously had a slight PR makeover. I would just say a slight PR makeover. But in my opinion, the big antitrust monopoly case that was filed way back, almost 2.5, 3 years back, that's been baking very slowly, in my opinion. And these cases are very complex. They take time. The discovery takes time. And think about what happened with Google. We went through the biggest antitrust case of the last 15 years, or the last couple of months. Still, we haven't seen much come out of that antitrust case. We expect something like that happen with Facebook at some point in first half of 24. We haven't heard much on what has happened between FTC and Facebook in the last 2.5 years. I think that comes to a head prior to elections, and that could be the only wrinkle that affects some of the sentiment on Facebook. But if what has happened to Google in the last 3 months is any kind of indication as to whether market will just skirt away new headlines coming towards Facebook, then I guess that gives me a little bit of extra confidence that investors would be willing to skirt away new monopoly, new antitrust, new regulatory headwinds in the first half of next year.
Well, I'm glad you mentioned the regulatory headwinds because that certainly impacts a lot of the names that you cover, including Amazon. And I want to get your take on FTC's lawsuit against Amazon. To what extent does that feel like a headwind for Amazon heading into 2024?
If I had to force rank the regulatory clouds on the three internets, I think I would put Amazon at the bottom. By that, what I mean is Amazon has probably the most delayed exposure to the monopoly case that was just recently filed. Probably it's more of a 2025 phenomenon and less of a 2024. 23 was Google. I think 24 is going to be Facebook when it comes to the monopoly case. And probably we'll hear more about Amazon versus FTC in 2025. These cases, as I said, take a long time. This case was just recently filed. Amazon has been, I would just say, jumping over landmines in Europe when it comes to these behaviors around them being perceived as a big monopoly. So I think they are kind of controlling the narrative slightly better than what Facebook controlled way back in 20 and 21. So again, all I would say is probably Google has the largest surface area, followed by Facebook. followed by Amazon, is the way I would look at it when it comes to them being viewed as a monopoly.
Well, hey, before we run out of time, I want to get to one of your other top picks that round out the trio, and that is Uber. And Maddie and I were sort of talking anecdotally about it earlier. And I wonder what you think the pricing dynamic is going to look like this year. And I ask that because many areas are seeing an increase in gig worker or minimum wage laws that are meaning that wages for these guys are having to go up. How much more pricing power, though, is Uber going to have when it comes to its passengers?
And that's a very, very important question. So these companies probably grow high teens growth rate next year. So the way I kind of slice that is probably 60-70% of the growth is in volume. So the volume of rides is probably low teens, so 10% growth in the number of rides in 24, and then maybe 5 to 6% growth in pricing. So that's above what probably we are going to see as far as industry inflation is concerned, but that's the amount of pricing they would need to pass on to consumers. And whether they'll buy it or not, that remains the key question, and that leads to some market share shift dynamics. And that's why we like Uber a lot more, given they have more ways to digest those pricing hits than Lyft can, given they control 80% of the market. And slight changes in pricing can hurt Lyft a lot more than Uber. So we like Uber. We like Uber a lot. I think other catalysts are advertising, subscriptions, new products like shared rides that are going to anniversary next year. So there are 3 clear product catalysts plus any market share growth that they could have.
All right, Rohit. Meta, Amazon, Uber, your top names to watch going into next year. Great to catch up with you as always. Thank you so much for that, and Happy New Year.
Happy holidays, Happy New Year to you guys.
Thanks. Well, staying on big tech, the combined market cap of U.S. companies valued over $1 trillion hit $10 trillion in 2023, doubling valuations from last year. Yahoo Finance's Jared Blickery is here to dig into what happened there. Hi, Jared.
Hi, Julie. Mag 7 has played out, so we're going to talk about the top 5, and that doesn't include Meta and Tesla, but this is just fine for analysis here. $1 trillion club, top of that is Apple with just over $3 trillion worth of market capitalization. You can see that in this yellow slice right here. By the way, the rest of the market, the S&P 495, that takes up 75% of the market. So we're talking about 25% concentration by the 5 top issues. This goes down Microsoft, Alphabet, Amazon, Nvidia, the latest entrance to the $1 trillion club. That's up to $1.231 trillion in market cap, and that was the biggest gainer this year, about 240% in the S&P 500. And I've charted these 5 stocks along with the rest of the 495 all the way back to 2019, so you can see what happened over the pandemic. And by the way, just notice this scale starts at 15 trillion, so 0 is actually down here. And again, about 25% of the market are these 5 stocks here. But I was running a PE analysis actually on the Mag 7. I didn't have it for these top 5, but it's a rough estimate. We're looking at a PE of about 35 right now, and just before the pandemic, it was actually much higher. It was up 55, or excuse me, at 50, and then just after the pandemic, it was 55. Regardless of how you slice it here, these stocks are a little bit less expensive than they used to be, so their earnings have kind of caught up here. Just want to talk about some of the other stocks here, the 495, and some of their industry groups that have really come alive over the last 43 days. That's since October 27th. The early part of the year, that was a magnificent 7. But you take a look at the top line here over the past 6 weeks. ARK up 54%. Then you got Bitcoin, that's Grayscale, up 38%. Home builders, regional banks, solar, IPOs, chip stocks, internet stocks, all up more than 25%. So been a pretty big year there.
Yeah, Jared, it's interesting to see some of the names that had struggled earlier in the year really picking up steam as we head to the year end and investors seek to get a little bit more juice here. Jared, thank you so much. We really appreciate it. Now, coming up, a new installment of our very own series, Goodbye or Goodbye. We'll be joined by an expert to break down the ETF investing landscape for 2024. Stick around.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, brought to you by E-Trade from Morgan Stanley. Our goal to help cut through that noise to navigate the best moves for your portfolio. And today we're taking a look at value versus growth. I'm here again with Steve Sosnick, Interactive Brokers Chief Strategist. Thank you so much for being here. Appreciate it. And your buy is value, the Vanguard Russell 1000 Value Index Fund, to be specific here. Now, I feel like the tale of growth versus value is a tale as old as time, but we'll talk about it again here today because it's worth talking about going into next year. So let's start with your bull case here on this. Valuation, you say, leaves it some room to top expectations. In other words, expectations are low.
Yeah, well, that's been the thing, and in this format, I always think like a long short trader. So to me, this is my mentality about this, and these go together. The difference here is the value, the Russell 1000 value, which is what VONV is based on, has a P of about 15, and looking at high about 15, almost 16. Then next year's forward PE is just about a little above 15. So it's really not very expensive. The lowest it really has been at a year end has been in the last few years has been 14. So there's not a lot of downside from that regard, and the expectations for earnings are relatively modest. Call it about 5% is what that forward PE implies.
Right, so if they do better than that, it then leaves it room to top those expectations. Secondly, we're looking at a dividend yield, and value tends to yield more, right?
Yes.
We're looking at dividend yield of 2.54%. So if you're looking at that versus the 10-year, there is a gap. The 10-year is still yielding more, but it's a gap that has shrunk.
Yeah, and that to me is a pretty compelling value. If you think about what everybody wants to earn returns on their cash. Now, in the case of a growth stock, the theory is that the companies can invest it in their high growth technology or whatever it is they're doing. In the case of a value stock, their prospects aren't necessarily as good, but they return the money to shareholders. And so if you're getting 2.5% on yield, and you'd have to go out and buy, pay $385, $390 to get a 10-year. That's not so terrible. It's obviously when you can get 4+ in a money market fund, 2.54 doesn't sound great, but the money market fund has no chance of really growing, whereas you do have some opportunity here in a value stock.
Right, you can get price appreciation as well,
Exactly.
which you're not going to get in the money market. And then sort of a flip side of what you were talking about first is the PE. You talked about the range that we have seen in the PE for VONV.
Yeah, it's been relatively modest. It's been basically, and I sort of just did 5-year year-end PEs, figuring what year-end now. In the high 15s, which is where we are on a trailing basis, that compares reasonably well. Again, as I said earlier, with its low it's somewhere in the 14s, and its high somewhere around 18, 19. So you're not going to get the massive PE expansion that you might get, but you also don't have a lot of downside to be worried about if it falls.
Gotcha. Well, we always like to talk about what the risk to the bull case is. And in this case, I guess it's just that people don't like value very much.
That's really what it is. I mean, investors have fashions, investments have fashions, just like everything else. Value has been tremendously out of fashion this year. The growth index, at least to get you again using these Russell 1000s, growth is up about 40%, 43%, I think. Value is up about 11%, and that 11% is pretty much all within the last 2 months. So there's really has not been a lot of interest in value stocks, and if Jared was out here talking about growth stocks. This is what people want to talk about, and so if that trend continues, value will underperform.
Okay, well, let's talk about growth stocks, though, and let's talk about the flip side of the equation here and your goodbye, which is looking at the VONG. So the flip side of that, the Russell 1000 growth. And so first of all, basically, it's the inverse of the other, that there are lofty expectations here being priced in.
Yeah, there's the PE is about 31 and change and expected to go down to about 25, 26 as earnings improve, but that implies about 15% earnings growth. That's a pretty high bar to match. Now, can these stocks do it? Even the Russell 1000 is not as top heavy as the S&P 500, but those same top stocks do dominate. But bear in mind, something like Apple's had negative revenue growth quarter over quarter for 4 straight quarters. So there's a lot of growth priced into this, and I just picked on the biggest stock. The flip side, of course, NVIDIA has phenomenal growth priced in. So it all mixes up. But if we are talking about a soft landing, maybe getting us 15%, and we talk about the potential for a hard landing, which is priced in certain corners of the market, we're not getting 15% on a hard landing scenario.
It's not priced in here. That much is for sure. The next thing is that it is, and this is what, when we talk about people being enamored of growth, it's a crowded trade. Now, you're really good at explaining things. So what is the problem with it being a crowded trade, with a lot of people liking it?
Well, the simplest thing is if everybody owns it, who's left to buy it? But when you think about what's going on, a lot of this, what we've seen in all markets, in almost every asset class, has been a year-end phenomenon. If you're an institutional investment manager, FOMO is a very real thing. It's fear. If you're an individual, don't succumb to FOMO. It's greed. That means you're just envious of somebody else doing better than you, and that's not a good way to invest. But if you're an institutional investor, you have no choice, because if everybody's doing better than you, that means you're doing worse, and that means your job is at risk. So everybody needs to pile into the stuff that's winning, and they tend to. We saw it last year. Everybody piled out of the stuff that was losing, taking tax losses. And in this year, it's been exactly the opposite. 2 years ago was a lot like this year, where we rallied hard into the end of the year. S&P 500 actually set the all-time record high, which we've been on record high watch. That was the first trading day of 2022, and we never looked back.
And we're about back to that level.
And so we're sort of around there. So that's what the idea of a crowded trade means. If everybody's fully long these stocks, who's the marginal buyer?
All right, we gotta get on to the. That's okay. So the downside in volatility. In other words, volatility has worked in investors' favor this year, but it doesn't always.
Well, as I mentioned, the growth stocks are up about 43%. The value stocks are up about 11% using the Russell 1000. Over the 2-year period, they're both about flat. So that means that the value is up about 1.5%, the growth is up about 3%. But bottom line is, for that volatility, you could have actually really left your money in the money market fund. And what it's also telling us is that this phenomenal rally that we've seen in growth stocks this year was basically recouping what we lost last year. And so that is the volatility. And when institutional investors like to think about volatility-adjusted returns, yes, it's great if you're making money, but if you're subject to a lot of volatility, that's not for everybody's taste. The value stocks have a lot less volatility, and over the longer term, they can provide you some return.
Yeah, and then again, it's the flip side that investors just have loved growth. So if they keep loving it, then it will continue to do well. And then finally, the chart that you've been alluding to here, the 2-year performance here of value versus growth, and they've both sort of gone a whole lot of nowhere.
But look at the volatility in the purple line, which is the growth.
That we have definitely seen. All right, I'm going to sum up what you have told folks here today. The case for value over growth. While growth has outpaced value this year, if you take a look at that 2-year time frame, you see both performing very similarly. So looking at where things stand now, you're telling investors buy that Vanguard Russell 1000 Value Index Fund based on compelling dividend yield, current PE implying less downside, and valuation leaving room to top expectations. On the other side, you're saying avoid the Vanguard Russell 1000 Growth Fund. It's a crowded trade, and there are lofty expectations in its implied earnings growth. Steve Sosnick, thanks so much. Really appreciate it. Happy New Year to you. Thanks for coming in to the studio. And thank you for watching Goodbye or Goodbye. Tune in Tuesday. We've got an all-new episode to start off a brand new year.
Zeroing in on biotech stocks, having a little bit of a tough year. They are up year to date, but the sector is lagging behind the broader S&P 500. Our next guest says we're going to see more rotation into biotech in 2024, but the bigger takeaway here, more M&A activity. So joining us now is Jefferies biotech analyst Michael Yee. And Michael, I'm so excited to talk with you about this sector and what's to come. But start us off with this increased M&A activity, this space really outpacing the rest of the broader market when it came to M&A in 2023. What will be the single biggest catalyst for more M&A activity in the biotech and pharma space heading into next year?
Well, it's good to be here and great to chat with you. I think it's a few things brewing, but I think the number one reason why pharma is going to continue to go after small and medium-sized biotech acquisitions is because of IRA drug pricing and patent problems over the next few years. This is the first year where IRA negotiation drug pricing is going to start to get implemented. So there's going to be a lot of pricing problems and headwinds on many of their blockbuster drugs, as well as an analysis we have done showing over $30 billion of biogenerics, biosimilars, and generic stuff coming over the next few years. So they've got to replenish the pipeline, and there's lots of small, mid-sized biotechs that are perhaps the next blockbusters.
Hey, Michael, it's Julie here. It's great to see you. I'm curious about the capacity of large cap pharma right now to make these acquisitions. We know, for example, Bristol has been on a little spree here, and I saw some commentary by one of your competitors earlier in the week that said maybe they were getting to sort of the limits of their capacity to make those size acquisitions. So who do you think are going to be the big buyers here in the market?
Well, it's a good point. I would say on one side, just to answer your question, Roche certainly has to do deals. J&J, one of the largest pharmaceutical companies out there, has yet to do a lot of deals. And let's not be foolish to not think that Lilly, the biggest pharmaceutical company in the world with about $100 billion of cash flow coming in on obesity drugs, is seeking to also add over the next few years. So there's a lot of companies out there. I'll also throw in Merck and even Gilead need to do deals. And certainly for these small acquisitions, Julie, I don't think that that's a big deal. What I would say, though, for investors is that it is a signal or harbinger to say if pharma is out there buying stuff up and paying 100% premium, and they think that that makes sense for them, it probably makes sense to start picking up some of these biotechs stocks that are down over the last 2 to 3 years. If you take a look at most of the charts, and certainly the XBI index, that those are probably representative of reasonable valuations, negative sentiment, and that's perhaps why these companies are doing these deals. I even heard one thought, which I think makes sense, although maybe we're giving pharma execs a little bit too much credit. Rates are probably coming down over the next 1 to 2 years. Stocks are probably going up. Probably need to start pouncing on some of those things before they make the move. So I think there's a lot of things going on there that suggest why it's probably a reasonable time that the sector could start to rally.
Well, I heard you mention obesity drugs, so I want to go there. Do you think that there's a cliff for the obesity drug market, and what is that cliff going to look like? What should investors be anticipating for that cliff?
Now, do you mean a cliff with the stock charts, or do you mean a cliff from sales?
I would say for adoption that would lead to more demand, that would lead to more R&D, that would lead to higher stock prices.
Well, I will answer it in two ways. If you think that there's an inflection, is that what you're referring to?
Sure.
Rather than a cliff? Yeah, I mean, if you think that there's going to be a big move, first of all, a lot of the stocks have definitely priced some of that in. Of course, I think we can reflect on the Lilly stock and the Novo stock, which have been two of the biggest performers, I think, across even the S&P, looking at Lilly, which is up 59% this year. And those drugs just got approved. One of the most important things to remember is that reimbursement across the U.S. does need to open up since the drugs just got approved. Lilly's drug for obesity, Zepbound, just got approved. And also supply. So without getting too much into the details, supply from a fill-finish perspective, it's pretty ironic that there's so much demand, supply can't even keep up. What I would say is that this is also an interesting year because what some of the biotech analysts and pharma analysts are talking about is that there's other studies reading out across a whole plethora of important and large indications from NASH, liver disease, sleep apnea, and other areas that are also important. So let's see where that goes. But certainly, just to be concise, reimbursement and supply need to open up. And since the TAM is so big, and there's just a lot of estimates about where that's going to be, I think there's still a couple of years to play there. So I think stay tuned there, but certainly we have a bit to go there.
Michael, do you think that's where some of the M&A targeting is going to be? Is it going to be obesity? Is it going to be Alzheimer's? Is it going to be cancer? Where do you think the bigger pharma players are looking to add?
Well, I think that in the areas of obesity, obviously Lilly and Novo and Pfizer continue to develop their pipelines there. And I think we're going to see different modalities, which are important. And reflecting on that, you are seeing other companies jump in with different modalities, particularly on orals, of which AstraZeneca just bought a private oral a GLP-1 company. And Roche just jumped in on a very small acquisition, $2 billion, for an injectable GLP to get into the mix. So if I were to analogize this as a bit like PD-1, where people are going to jump in, I want to be concise by saying, look, there's going to be more deal making in obesity because the TAM is so large. There is a market of different types of populations who want orals, injectables. I'll always use that opportunity to point out that Amgen remains my favorite large cap drug stock because they have the next potential big injectable drug with a potential monthly, and in some cases possibly quarterly, versus the weekly injections, and that date is in 2024. So I like Amgen. But this is still a ways to go. So I think obesity is one area. I would definitely say that you can't just say it's just going to be obesity, neurology, Alzheimer's, but more broadly than just Alzheimer's, schizophrenia, depression, Parkinson's, other important areas. You know, neurology is perhaps one of the biggest epidemics across our country. And there's millions and millions of patients suffering from Alzheimer's and certainly all sorts of other CNS diseases. So that's an important area. And then always cancer as well. I mean, 35% of the biotech sector is oncology because there's a lot of unmet need there. So yes, all three of those areas are important.
Yeah, most definitely. That's an amazing stat on the latter front. Michael, I want to double click on Amgen a little bit here because of that being your top pick. Obesity, one of the reasons to buy there. What are some of the other things that you're watching out for from Amgen in the coming year?
Yeah. So we like Amgen, and clearly the obesity program where they have important data on the injectable drug called 133 that will have some of that data on a monthly injection, which could be a big event later in 2024. They also have an oral drug called 786. I think people are pretty lukewarm on that, as I am, so I wouldn't overhype those expectations with data on the oral drug in the first half of 24. But I think two more important things are also the acquisition of Horizon, which they did last year. You recall that there was a long or a bit of a prolonged delay due to the FTC pushing back. It's a whole separate topic. FTC ultimately giving in and certainly letting that deal go through. So a pickup and a great synergy and earnings accretion, so hitting numbers after the Horizon acquisition this year. And also they have a bunch of other drugs that sort of seem to get, dwarfed by the obesity program, which is a new atopic dermatitis drug, an OX40 with phase 3 data later in 24, as well as a new small cell lung cancer drug called tarlatamab that's just got filed to the FDA as a priority review. So many things going on there, of course, all dwarfed by obesity, though, to be clear.
Michael, it's always great to tap into your vast knowledge in this area. Really appreciate your time today. Have a great new year.
Sounds great. We'll see you soon.
See you soon. Thank you. We are also looking ahead to the year for the economy, especially considering it's an election year. Bidenomics has been complicated for the White House as the president's approval rating hovers near record lows despite a pretty solid economy. Rick Newman here with the details on the final trading day of the year. Hi, Rick.
Hey, guys. I looked at some things that went right and some things that went wrong in 2023 to figure out what Biden needs to have a pretty good shot at re-election in 2024. So some really important things did go right for Biden in 23. I'll just tick them off really fast. I'm listing 4. Inflation came down sharply. Job growth and economic growth held up. That's the so-called soft landing. We're having this great stock market boom to end the year. S&P 500 up 24% for 2023. And energy prices got cheaper, and that's a big one that voters care about, obviously. So there's a little bit of momentum at the end of 2023 here with consumer confidence picking up a little bit. Perhaps the shock of inflation is finally starting to wear off. But there are some other things that are going wrong, and just to go through them really quickly, there's some new data from the St. Louis Federal Reserve that shows that financial stress is actually getting worse, and that is measured by an increase in delinquency rates on auto loans and credit cards that is now as bad as it was during the Great Recession in 2008 and 2009. That obviously is not good. We've got problems with wars. People are freaked out about wars. And that migrant crisis on the border is a real train wreck, and Biden does not seem to have his arms around that, and that could get worse before it gets better. So a lot of different forces playing against each other as we go into 2024.
Rick, we know that voters really don't like being told that the economy is better than it feels to them when they are checking out at the grocery store. This is a recurring theme that I've heard from voters when covering these elections. Talk to me about where the biggest problem lies in Bidenomics. Is part of it a branding problem for President Biden when he inevitably hits the campaign trail, or is it in the specifics of the policy?
I think the biggest problem for Biden is now food inflation. We actually did a Yahoo Finance survey in November and asked people to break down the different types of inflation and say, which of these is the biggest problem for you in terms of your family budget? And by far, it was food inflation. And that makes sense because food inflation has been in the double-digit on a year-over-year basis for much of the last 2 years. It has now come down. It's in better shape. But, you know, if you're a family and you're feeding 3 or 4 kids and things are 10% more at the grocery store, you're really feeling it. So that's what voters told us, and that's what Biden needs to watch out for.
Rick, thanks so much. Really appreciate it.
Hi, guys.
Happy New Year.
Same.
Now we're at the closing bell on Wall Street here on the final trading day of the year for what, by many, many accounts, has been a surprisingly strong year for equities, for the economy, as we've been discussing here, ending on a little bit of a down note, but even so, big gains for the year for the major averages. The Dow down just about 20 points on the day. The S&P 500 down about 0.25%, and the Nasdaq down about 0.5% on the day. But on the year here, if you look at the 3 major averages, the Dow up 14%. The S&P 500 up 24%, the Nasdaq up 43%. Not too shabby here as we close out the year for the major averages, even if you have that little bit in pullback.
Yeah, not too shabby at all, and to the point that you've been making today, Julie, a 9th straight week of gains in the S&P is not necessarily bad news when it comes to closing out the year.
Yeah, a couple of little superlatives here as we close out. The Nasdaq 100, so the 100 largest stocks in the Nasdaq Composite, up 54%, the best year since 1999.
Yeah.
The Composite, we were looking at some of these numbers too, so we'll see if it's the best year since, as we watch for it to kind of settle out.
Yeah,
here.
we love a superlative too, and just what's interesting to me too is when we look at the losers on the day, at least Uber getting a little bit of a ding on the street, down 2.6% following that downgrade that we've been talking about, Julie. Paramount and Warner Brothers also in those worst performing stocks. But just to get to a little bit more positive news, some trending tickers from the year on our Yahoo Finance platform. Not a huge surprise here, Julie. Tesla, Nvidia, and Apple among the best performers in our top trending tickers of the year. All of these names having a lot of excitement on the AI play, also part of the Magnificent Seven when you look at an Nvidia and an Apple. Interesting too, I've been seeing some charts comparing Tesla's performance to Bitcoin, and they fall in very similar highs and lows throughout the year, so maybe a similar investing profile there. But not surprising to see these names doing well in a year where we were looking for some safe haven trades in these big tech names that were powered by the AI boom.
Yeah, so Tesla and Apple having their best years since 2020. Interesting because, as Steve Sosnick mentioned to us a little while ago, revenue was declining for Apple, and yet the stock still managed to gain. NVIDIA, not surprisingly, best year ever in terms of its performance, powering it to a new record. What I find interesting about these three names as well is that they are all well-known. NVIDIA has become a well-known consumer name, even though it is not a directly consumer-facing product, obviously, but it goes into a lot of products that consumers use. So it's interesting, this sort of intersection between them being of most interest to Yahoo Finance users, them being top performers, and hopefully for people, they were long these names and they ended up having a good year.
Hopefully they were happy. I mean, I'm really interested to see how the Tesla double clickers on our platform feel heading into next year. We know that UBS is anticipating that electric vehicle sales were about 47% this year in growth. That's going to go down to 11% growth next year. That's not necessarily a good leading indicator if you're long on a name like Tesla, but maybe the AI boom, maybe if they can mention that enough times on an earnings call, that'll help them.
Well, and also Elon Musk has tried to manage expectations around that as well, and tried to set the bar kind of low going into next year. Let's also take a look at some of the other stocks that we've been watching closely this year. Cruise stocks, sort of a surprise here at the top of the S&P 500, along with these large cap tech stocks. Royal Caribbean, the third best performer in the S&P 500. Carnival coming in at number 6 here. So it's been very interesting to see these cruise stocks really perform well and finish the year strong, as well as we got the so-called revenge travel boom. And we just recently spoke to Josh Weinstein, who's the CEO at Carnival, and he talked about the visibility that they have into 2024 is remarkable. The bookings, the strength in bookings that they are seeing at this point in the year, he says, is basically the best that it has ever been at this point looking out into next year. And so investors really paying attention to that. Debt is still an issue for some of these cruise line operators, but they're working to address it. That's something also that investors have been happy about.
It's another one of those surprising names because I keep waiting to see evidence of this shift away from services over to goods. So you see a Royal Caribbean performing well in the stock market, you see a Nike down. I'm not seeing the big shift from service spending to goods spending in that exact comparison dynamic. So I wonder whether or not that prediction is going to play out. Is inflation making consumers maybe think, okay, a cruise, you can get a little bit more bang for your buck in that type of travel? Or is revenge travel just here to stay? People got used to traveling a lot and now they're going to continue.
We'll see.
Yeah, we'll see. As always, Julie.
Well, and to round things up, we got some surprising performances of the year.
We do have some surprising performances of the year, Julie. Thanks for that. I do want to talk about Abercrombie and Fitch, not to really pull away from Brian Sozzi here by talking about this name. I know he loves to talk about it, but this name is up 300% if you look at the S&P 1500 index. So a little bit of a stretch there, but outperforming NVIDIA if you look at their 260% year-to-date returns, Julie. So I just found that really interesting. This is one of those names where the CEO, Fran Horowitz, has been able to really rebrand the company, having obviously a lot of public relations challenges over the years, expanding also into things like athleisure, workwear, event wear, and that kind of product diversification has been rewarded by the street and by consumer sales.
I mean, something I found so fascinating about Abercrombie is it's sort of grown with its customer base. I think of Abercrombie, or I thought of Abercrombie as largely a teen brand, but I know many of the 20 and 30-somethings at the office who love it, going back to our anecdata, right? So I think that's kind of a fun thing about Abercrombie. The big surprise for me this year, or one of the big surprises, has been the underperformance of solar stocks, right? The Invesco Solar ETF seeing a decline of about 26% this year. TAN is the ticker on that. Why has it been surprising? Well, and we've seen some individual stocks do really lousy as well, because we had the IRA, right? The Inflation Reduction Act that was supposed to really inject a lot of incentives into this industry. One of the things that has hurt the industry has been California has sort of changed the way it subsidized rooftop solar panels. That was a setback for the industry. And we've seen residential solar installations, according to Bloomberg New Energy Finance, which tracks this industry very closely. Residential solar installations in the U.S. rose an average of 32% per year from 2019 through 2022. Now they're looking for only 5% annual growth for the rest of the decade. So there's just been a real slowdown there, and we have seen the stocks follow suit, although there is some bullishness from the street on solar going into 2024. Again, we'll see.
Again, we'll see. And again, I feel like that's another one of those baskets that kind of depends on where things go with the Fed because of the way those contracts are financed. So that's going to be, again, another interesting to watch, Julie. But 2023 coming to a close for the market. We're going to get a deeper dive on the performance. Yahoo Finance's Jared Blickery has the recap. Hey, Jared.
Hey there. Well, let's take a look at the Nasdaq 100. That's the index to look at. That's where the Mag 7 is, by the way. Talking about the Mag 5 or the top 5 a little bit ago. But here's where the action was concentrated. Tesla up 101%. Meta about the same size, doubled. You see Amazon up 80%, Nvidia up 240%. But let me go through the sectors. Been really interesting to see how this breaks down and to see the game of catch-up we had at the end of the year. These top 3, which house the mega caps, that's XLK with tech, communication services also above 50%, and discretionary, that's consumer discretionary up 38.5. Those have been the leaders all year long, but we did have some other sectors catch up over the last 2 months, and that would be financials, real estate, also industrials. So talking with Steve Sosnick about value and growth. Value did a tremendous job of catch-up this year. And let me put our leaders on the year to date, and you can really see Bitcoin by far and away the biggest leader here for the year. I've got a couple different measures there. New York FANG, that's basically the Mag 7, up 96%. ARC, that's disruption, up 67%. Chip stocks, home builders, software, the Qs, that's the Nasdaq 100, over 50%. So a lot of love for a lot of different sectors, but not all of them. Here's solar, that's down 26%. Cannabis down 24%. Solar, by the way, had a nice comeback, but you take a look at cannabis, and I did a deeper dive on some of the industries and stocks that were pandemic darlings or darlings before then. A lot of these are just not coming back. You can see that's not much of a comeback story compared to this 5 years of prior price action. Let me just show you what's happened with meme stocks, because it has been a game of have and have nots this year. Coinbase, with the resurrection of Bitcoin finally coming out of that, exiting out of that the winter for crypto, that's up almost 400%. Palantir up 167%. But some of these names probably not going to come back for a while. And included in that is AMC. And let me just see if I can find that real quick. It is a much smaller stock than it used to be. That is down 85% for the year. That's kind of an ugly chart. And on the 2-year, you can see it's down 97%. In terms of the U.S. versus the entire world, we saw a lot of bullishness around the world. I have the Nasdaq up 43%, not exactly the U.S. benchmark. That would be the S&P 500, but that's the leader there. The Nikkei, that benchmark is up 28%, arguably the global leader there in front of the S&P 500. Then we have Spain, we have Brazil, Germany, Korea. So a lot of bullishness to be celebrated around the world. We'll have to see what happens in 2024.
We will indeed. Jared, thank you so much for that roundup. Really good stuff. I love the check on the meme stocks.
You bet.
Sorry, apes. Not a great year for you. All right, joining us now, Dave Mazza, Chief Strategy Officer at Roundhill Investments, to talk more about the year that we've seen and what we may yet see. Dave, great to see you. Thanks so much for being here. It's good to talk to you on the last trading day here. So we have seen, as we have been talking about, this domination of the Magnificent Seven, and we have been trying to figure out what happens in 2024 with not just that group, but sort of the group around it. What's the next hotness in the market, Dave?
No, you're absolutely right. I think first and foremost, we've talked ad nauseum about how surprised everyone was with the great performance of the markets, really led by that AI trade and the Magnificent Seven group. But when we start thinking ahead to 2024, I actually think we're going to end up in a market that is bifurcated like we've continued to see, but in a bit of a different way. So until we see those rate cuts, there's no reason why the Magnificent Seven stocks likely may not continue to outperform, even if people are uncomfortable with that, right? They were unloved at the beginning of the year. The flows weren't there until recently, and now they've started to come because everyone was hanging out in T-bills and money market funds to earn a yield that they hadn't gotten in decades. That begins to change, though, when those rate cuts begin to happen, which could be as soon as the spring, if not the middle of the year, if we start to see some of this economic data continue to fade because we know that that Scrooge of inflation has finally started to come down.
Well, the Scrooge of inflation is coming down, but the market doesn't seem to be interested in looking at the real Scrooges. And I'm curious your take on this idea that if the good news is making the market go up, why would you worry about any of the Scrooges in the room? Something like narrowness in the rally. What is your take on the market's ability to ignore any of those negative realities that could be to come?
Yeah, no, you're spot on. The market, I think, has done an excellent job of focusing actually on some of the fundamentals. And some of the fundamentals, as surprising as that may seem, have been that we're actually out of the earnings recession. The most recent earnings season, it was really, again, powered by the Magnificent Seven, those big tech giants, which are not just one company, but in many cases, 5 to 10 companies combined into one publicly traded company, which is a bit of the reason why they may be misunderstood as a group. That is really beneficial because now we actually see further earnings growth and further revenue growth on the horizon. When you couple that with a decrease in inflation, even as we start to see some employment data begin to perhaps tick up, those are actually all positives. The one big negative and question mark that's out there that never happened this year, that certainly at some point is gonna have to come home to roost, is the consumer, because we are beginning to see some signs there of some stress, right? We know that there is subprime auto loan delinquencies. We know that credit card spending is increasing. We know the use of buy now and pay later is increasing. So the stress in the consumer is starting, but for the time being, we're not seeing it. And that's one of the reasons why valuations in the market have gone up so sharply this year. But we're going to need to see those earnings and revenue growth continue to come if we expect the market to power higher.
So, Dave, when we talk about places to look in 2024, I know one of the places you're looking is at high dividend payers, and specifically what we're calling dividend aristocrats, which sounds very fancy. What do we mean by dividend aristocrats? Is it consistent dividend? Is it growth in dividends? What are you focusing on?
Yeah, no, it's exactly the consistency of the growth that makes a dividend aristocrat. So a dividend aristocrat is a company that has increased their dividend each and every year for 20 or 25 years. There's another group, even stringent to get in, the dividend kings or the dividend monarchs. That's 50 years of consecutive dividend increases. And why am I looking at that group as an option away from the Magnificent Seven, even if the base case is that the Mag 7 continues to power the market higher, at least in the beginning of 2024? It's because they tend to be incredibly resilient. If you've been able to increase your dividends for that long of a time period, you have strong free cash flow to be able to pay those dividends to investors. And what's interesting is that those names have been incredibly out of favor. In fact, the S&P High Yield Dividend Aristocrats Index had its worst ever relative performance compared to the S&P 500 going back on record last year because they had that index has no exposure to Magnificent Seven, underweight names like technology, and overweight staples and utilities. So when you get rate cuts, those are the sectors that historically do well. I am still concerned, everyone's saying, well, let's rotate out of the mega caps and go buy small caps. Generally very logical. The challenge is that many small cap companies remain unprofitable. They remain actually challenged because there's such an overweight to regional banks and biotechs. And there's some question marks about just moving into the small cap space. So if I'm looking to rotate, I actually want to stay with high quality names, which you're going to find with the elite dividend growers in the aristocrats and dividend monarch space.
Yeah, I guess another way to look at that, Dave, is that there's nowhere to go but up when you talk about that comparison to the broader S&P 500. I'm curious, though, dividend plays to me spell safety, spell conservative, which indicates to me that you might have a recessionary take on 2024. How are you squaring your view of the broader 2024 macro outlook with your view on the upside for dividend plays?
Yeah, no, you raise an interesting point because historically the best performance for high growth and high dividend names have come in down markets, right? So actually in 2022, they had great performance, incredible relative performance compared to the S&P 500, and that reversed in this year. So when we start to think about 2024, the macro, I do think we start to see the catch-up of the consumer happen somewhere around the spring to the middle of 2024. But the Fed is really trying to thread this needle. And they've done, and there's a lot of naysayers out there, they've done a great job with trying to engineer this soft landing to date. The challenge begins, and we were talking about that in the segment before, we have the election coming. We know the Federal Reserve has a ton of political pressure on it, even if they do their best to ignore it. And that only grows when we think about the likely candidates coming in the next election cycle. And so I think they may actually end up getting themselves in a rock and a hard place with beginning their rate cuts when you're too close to the election, because I don't think they want to be seen as influencing it to a great extent. So we may end up in an environment where the consumer starts pulling back at sort of the worst possible time for the Federal Reserve, which is why I'm less favorable on markets in the second half of 2024 compared to the beginning of 2024.
Yeah, Dave, you make a great point that we've heard a few guests talk about, which is the politicization of the Fed. Regardless of whether or not they like it, it is an election year next year. So interesting to watch. Dave Mazza, really appreciate it. Thank you and Happy New Year. Now coming up, we're wrapping up our final show of the year and we're getting you set for what to watch next week to kick off 2024. So stay tuned for more.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
A new paper out from the National Bureau of Economic Research. It's coming out this month about the risks of commercial real estate loans on bank balance sheets. The report indicating that if interest rates do remain elevated and property values do not recover, default rates could reach levels comparable or even surpassing those seen during the Great Recession. For more on the commercial real estate cliff, we're talking to one of the authors of that paper, Erica Zhang, who is USC Marshall School of Business Assistant Professor of Finance and Business Economics. Erica, thank you so much for joining us. This paper caught my eye. This has been a big topic of discussion, whether CRE on bank balance sheets was going to be a problem. What are the key things that you were watching? What is the situation as it stands here in terms of the status of commercial real estate?
Great. Thank you so much for having me. There are several reasons why CRE has been viewed as having an elevated stress risk. On the one hand, the commercial real estate faces increased business risk that decreases the fundamental values of properties. For example, the office properties are under significant pressure due to remote and hybrid work patterns, and the lower demand for offices can also negatively impact the demand for other commercial real estate properties like urban retail, multifamily, and also hotels. And on the other hand, rising interest rates make it very difficult to refinance CRE loans, which increases the financial risk of CRE. And most of the commercial real estate loans are going to mature in the next few years, and declining property valuation and rising interest rates make it very difficult to roll over the debt, which could lead to maturity default, which is the focus of the first part of the paper you saw.
Erica, first of all, go Trojans. But second, I do want to talk to you about that debt rollover, because I'm curious, and you talk about 15% of CRE loans underwater, 45% of those are office loans. Are those loans coming due going to be the catalyst that bursts the CRE bubble?
Yes, so if we look at all of those CRE loans, and if we measure the potential default risk using two important measures of the stress risk, loan-to-value ratio and debt service coverage ratio, they don't look very good. I can give you some numbers if you are interested in the specific numbers.
Sure, give us some numbers, Erica.
Yeah, so the loan-to-value ratio, or LTV, can tell us whether a loan is underwater, right? So in other words, whether the market value of the property is lower than the outstanding loan amount, and we know that an underwater loan is very difficult to refinance and faces high default risk. What we find using loan-level data is about 15% of all commercial real estate loans are underwater. And among all types of commercial real estate properties, the office loans face particularly high distress risk. And about 45% of office loans are underwater, like what you just mentioned. And if we compute the debt service coverage ratio, which tells us whether a property's annual cash flow is sufficient to cover its debt obligation, we can look at whether the property's cash flow is sufficient, right? And so the average debt coverage ratio was about 2 to 3 when those loans were originated a couple of years ago. And if we know that if this ratio falls below 1, it means the property does not have sufficient cash flow to meet its annual debt payments. And we find more than 6% of the CRE properties with the debt service coverage ratio below 1 by the third quarter of this year. And this is due to the declining property cash flows and rising interest rates on certain loans with adjustable rates.
So
this calculation is still just based on the interest rate the CRE operators received a while ago when interest rate was still very low and when their property values were still high. And we actually find a much higher risk if we think about refinance difficulty.
So what is going to be the catalyst perhaps then for a wave of defaults that's implied perhaps in those numbers? What is going to happen this year? Is it that that they're going to be forced to try to refinance? What's going to happen in 2024?
Yeah, so as we just discussed earlier, many of those loans will mature in the next year or so. Right? So they may not be able to roll over the debt because of the declining property values or inadequate cash flows. And even if we assume they could successfully refinance the loan, the new interest rates they would receive were going to be significantly higher than the current rates on those loans. And so based on our calculation, about 17% of those loans and about 25% of office loans in particular would end up having debt coverage ratios less than 1, which means their annual cash flows were not sufficient to cover the annual debt payment. So I would say it's because of two reasons. One is increase the business risk, and also if the interest rate would stay elevated, that's going to really increase the interest rate on the commercial real estate loans.
I'm curious, Erica, if you can talk me through the impact this could have on the macroeconomic environment, because in your paper you talk about 231 banks having negative equity, additional 31 insolvent, and you make some comparisons to some really dire times in our economic history. Talk to me about what that outlook looks like heading into next year.
Yeah, that's a very good question. So what we find about CRE distress risk suggests that if interest rates remain elevated and property values do not recover, then CRE loan default rate could potentially reach the level during the Great Recession, which was about 10 to 20%. And so the question is, what does this 10 to 20% CRE loan default translate into bank stability issues, right? So we then really want to understand the impact of a 10% default rate, which is a very conservative estimate on bank stability. And so the question is, how much does CRE loan make of banks' balance sheets? So CRE loans account for more than 10% of aggregate bank assets. A 10% default rate on CRE loans would result in about $80 billion losses on bank assets. And this amount alone actually would not lead to any bank failure if we were still in early 2022 when interest rates were low. Right? But the rise of interest rate already led to a more than $2 trillion decline in bank asset value, according to our previous research.
Right.
And more importantly, smaller and mid-sized banks had the largest exposure to interest rate risk, which also disproportionately hold more CRE loans. That's where the problem is.
All right, Erica Jung, we're going to have to leave it there, but really appreciate your insights. Thank you so much. Erica coming from the great University of Southern California. Now it's time to watch what we've got coming up next week. Another shortened week. Markets closed on Monday, but earnings season right around the corner on Jan 12th, kicking off there. But we got some results coming in next week too. ConAgra and Walgreens both reporting on Thursday ahead of the open. then washing it all down with beer importing giant Constellation Brands reporting on Friday. Then we go to the economy, the job market. The Bureau of Labor Statistics releasing its monthly JOLTS data for November. Job openings expected to rise roughly 8.8 million from the 8.7 million in October. Sticking with jobs, we've got ADP next week, and then on Friday, monthly jobs report for December. The economy expected to have added 168,000 jobs this month, which would be a slowdown from November. Unemployment rate expected to tick higher to 3.8%. And guys, Happy New Year. This is very exciting. Julie, I'm honored I got to close out 2023 next to you. And what are you looking forward to?
What am I looking for? Oh my gosh, that's such an open-ended question.
We're gonna have to talk
Continue
about
to live the dream. You know, that's what I'm looking forward to.
Some good music from you, I'm sure.
Definitely. All right, that's gonna do it for the final Yahoo Finance Live of the year. Come back on Tuesday. We'll be here 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. We need some
confetti.
Fireworks.
The guys earlier got champagne. I feel like we got snubbed.
We'll go off camera to have our
we'll
champagne.
Be fine. We'll
Happy
get
New
it.
Year, everybody.
Happy New Year.